All right, well, a sour start to the year yesterday for U.S. equity markets. A bit of a rebound today. Romaine Bostic here alongside Katie Greifeld. This is Bloomberg Markets to Close.
We are waiting those Fed minutes. Any clues on what could come at February's meeting? Any commentary on the jobs market, obviously, will be very much listened to.
Yeah, a big February meeting up ahead. Of course, we had that December meeting. We know what happened with regards to the decision, what went on behind closed doors. We're about to find out. Those minutes coming now. Michael McKee standing by with the readout.
No real indication of what the Fed is thinking of for the next meeting on February 1st, but in December, they saw an economy that was still running too hot in terms of the labor market and inflation that was still unacceptably high. They did face a concern, however, that with most of the credit impulse that they had put into place yet to hit the economy, they had two risks. One, tighten too little and let inflation and expectations go up too much, tighten too much, and risk recession. So to make sure they understood what was happening, they dialed back their restraint to 50 basis points this time. However, they were worried financial markets might get the wrong message, which may be why Jay Powell was very hawkish in his press conference. Financial conditions were loosening, the minutes noted, even in spite of the Fed's tightening through 2022. They wanted to ensure that investors understood that slowing did not mean any weakening of the Fed's resolve. They intended to keep raising rates and to leave them elevated through 2023. The minutes pointedly note that nobody suggested a rate cut was possible this year. But in spite of their tightening through 2022, financial conditions being lower were allowing inflation to continue, and that inflation was being represented by companies' markups being high, service inflation was taking the place of goods inflation, and interest rates had to go higher to bring down demand enough for inflation to ease. Fed staff, meanwhile, which had said in November the chance of a 2023 recession was 50-50, backed off that a little, saying by December the economy had improved some, but that a recession this year was a plausible alternative. Guys?
A plausible alternative. Michael McKee, I am curious, when we heard from Jay Powell at that press conference on December 14th, he did talk a lot about the labor market and the idea that it was out of balance. Is there any sense of that same sentiment reflected in the minutes?
That's exactly what's in the minutes, that although the labor market was improving a little bit, there were still too many job openings and not enough people available to take the jobs. And the Fed needed to cool the economy down enough so that demand for workers would slow.
And looking through the headlines here, one of them is the Fed officials generally saw inflation risks as a key factor. And that's one of the debates that's going on in markets right now, is when the Fed really shifts from inflation concerns to growth concerns. Was there any hint to that in these minutes?
Only the slightest of hints, in the sense that they set out the two risks that they faced, and tightening too much and recession resulting is one of those risks. However, they still felt inflation was too high. They celebrated the fact that it had come down the prior 2 months, but said they still needed a lot more evidence to ensure that it was going to continue on its way down. And the minutes say they felt the inflation risks remained elevated.